In today's episode, I'm going to teach you how to stop selling your winners too soon. This is a habit that so many traders fall into. You get into a trade, you have the right idea. As soon as it goes up a little bit, you sell the whole thing, you take your profit off the table, and then you watch it continue to move up without you. Instead, when you have a good entry, hold until you get a valid exit indicator. And for those of you guys who haven't already met me, my name is Ross Cameron. I'm a full-time trader, and I turned a small account with less than $600 into more than $12.5 million of fully verified and independently audited trading profits. We'll talk a little bit more about that small account challenge as we go through this episode. For those of you guys returning to the channel, I hope you hit that thumbs up. You know that we're about to dive into a deep, comprehensive training. And for those of you guys who are brand new, I hope you hit that subscribe button because you're about to learn a lot. So let's jump onto the screen share. We're gonna talk about the complete guide to exit indicators on your candlestick charts. Now let's begin high level by answering a question. Why is it that candlestick charts and technical analysis work so well? Well, it's because candlestick charts and these technical indicators that I'm gonna walk you through today are part of the universal language of the financial markets. They are well respected. So when you have an instrument, well, it could be any stock, it could be Bitcoin, something that a lot of people are paying attention to. What are people looking for? They're looking for an opportunity to buy something that's strong. And so technical analysis gives us a framework for recognizing low risk areas where we can take positions that has more upside potential than it does downside risk. And because these signals become so obvious, thousands, potentially hundreds of thousands, even millions of investors and traders around the world are following them and respecting them. And so they become a bit of a self-fulfilling prophecy. You think about traffic lights or the rules of the road. You stop when you see a red light. Why does that work? Well, everyone follows it. Everyone understands that this is the way you drive. When you see a red light, you stop. When you see a green light, you drive. Whereas with candlestick charts, there are certain very clear patterns and candlestick shapes that represent sell signal. Do not buy here. And if you're holding, you better be selling, you better be out. And there's other patterns that represent very clear buy signals. And so the market responds accordingly, as you would expect, to these predictable patterns. Now, one thing that I'll share with you is that the exit indicators that you're going to learn about today will work, but only when you're trading something that is obvious. So what does it mean for something to be obvious? Well, as many of you know, I trade stocks in the market. I trade stocks. So whether you trade Forex, futures, cryptocurrency, or you're trading a different exchange, I'm trading stocks listed in the US market. So these are New York Stock Exchange or NASDAQ listed stocks. And this right here is a stock today that is up 223%. It's got 78 million shares of volume, and this is the chart. This is a stock that I traded just today, and I made $33,000 on it. How did I make that money? It wasn't from fundamental analysis. It wasn't from reading the balance sheet or the quarterly earnings statements of the company. It was from technical analysis. And the reason I made that much was because I didn't sell my winners too soon. I held that position until I got that valid exit indicator. And so naturally, a very strong exit indicator is going to work a lot better on an instrument that a lot of people are watching. So what I want you to understand is that technical analysis works when applying it to something that a lot of people are paying attention to, because people will react to the signals, the buy or sell signals. Whereas on the flip side, if you pull up, I don't know, just a random stock here that has basically no volume today, this has no volume. And so anything you see on the chart really doesn't carry any weight. Even if you thought you were starting to see a pattern, which I don't know how you could possibly see in what we're looking at here, but let's just say you thought maybe this is support off this level. Odds are nobody else is looking at this today. So there's going to be no one that's buying it, and there's going to be no one that's selling it. There's just absolutely no interest. So it's sometimes a myth that candlestick charts and technical analysis work 100% of the time. They work really, really well when you're trading something that is obvious. So why don't we begin by quantifying what obvious means? Because if you're going to be trading and using these exit indicators, I want to make sure you're applying them to the right instrument. I have what I call my 5 pillars of stock selection. Number 1, and this is for me, I focus on trading stocks between $2 and $20. And I do that not just because it's my opinion that that's where I make the most money, but because based on all of this data, this is millions of dollars of trading profit that are analyzed in this reporting software that I'm using. All of my profit comes generally, the bulk of it, from lower price stocks. Stocks between 2 and 20, right there. So I focus on trading stocks between 2 and 20. And number two, I focus on trading those stocks when they're up at least 10% on the day. And I prefer to trade a leading percentage gainer. So what's a leading percentage gainer? A leading percentage gainer would be a stock like Zcar today, which is up 220%. KIDZ is also the second leading percentage gainer. RNAS is the third leading percentage gainer. And this is in the entire US market today, which is why these have so much volume. 78 million shares, 343 million shares, 200 million shares. I mean, you're talking about billions of dollars that are trading hands on these leading percentage gainers. So essentially, every trader out there is going to be focusing on these stocks today. Now, what I know is that the stocks that I make the most money on not only should be the leading percentage gainer, should be priced between 2 and 20, but should also be experiencing 5 times higher relative volume today than what is normal. So every stock has volume, and what we call relative volume is a measurement of how much volume the stock has today relative to what's normal. So for example, if a stock typically has 1 million shares of volume, and then today it has 10 million shares of volume, the relative volume ratio is 10. If it has 100 million shares of volume, the relative volume ratio is 100. And so the bigger the ratio, the bigger the extreme that's happening today is. And why would a stock suddenly have 5 times, 10 times, 20 times, or higher relative volume today? That's typically the result of fourth criteria or pillar of stock selection, breaking news. Now, when you have breaking news, what breaking news creates is demand. So on the other side of demand, we have supply. And so what we're looking for is supply, a float of less than 20 million shares. So if you were trading cryptocurrency, you would be looking at the total number of coins issued for the currency you're trading. That's very common. When we're trading stocks, we're looking at the total number of shares that were issued during the initial public offering. So the initial public offering, and then subsequently any shares that were sold onto the market or any shares that were bought back, create the current float. That's the number of shares available to trade. And so what I know is that when we have a stock like Zcar, which has a total outstanding float of just 384,000 shares, that this is a stock that has a very limited level of supply. So when it has heightened demand, it can make a big move. That's the imbalance between supply and demand. So technical analysis and candlestick charts will work best when applying it to an obvious instrument. And in my case, that's going to be a stock that meets all 5 pillars of stock selection. But just because a stock meets all 5 pillars of stock selection doesn't guarantee that I would trade it. Well, why not? It's possible that by the time I actually pull up the candlestick chart, I realize that there's not a pattern that I can trust. And so for my strategy, not only do I only focus on trading stocks that meet these 5 pillars, I also have to make sure there's a clear candlestick chart pattern that I can understand. So here's what I'm going to do for you guys. I'm going to put a link, I'm going to pin it to the top of the comments and also link it in the top of the description where you can download my 5 pillars of stock selection as a PDF worksheet. And you can also download my 112-page technical analysis PDF. In that PDF, I'm going to have all of my favorite chart patterns and lots of examples of how those patterns worked out, and you can print them out. The reason I want you to do this, I want you to print them out and I want you to put them around your desk, because when you then in real time are seeing one of these patterns forming, you're going to see the example of what it looks like, and you're going to see, wait a second, this chart is starting to match the profile of exactly what I'm looking for. This is kind of the funny thing with trading, that when you're actually looking for a pattern in real time, you can only see the part of it. And you have to visualize what you think is going to happen next. So let's look and zoom in on this pattern right here. This is actually one of my favorite patterns. We call this a bull flag pattern. And so what's happening here is suddenly we get a surge of momentum and the price rapidly goes up. That's typically because some type of catalyst or event has just occurred. Usually it's breaking news, but it doesn't have to be. So you get this rapid squeeze up on high volume. Now what this triggers is the stock to then hit scanners. So what it's gonna do is it's gonna hit these scanners over here and fire off alerts. Now I have these scanners scripted to search the market in real time for stocks that meet my 5 pillars of stock selection. But you know what? It doesn't really matter what broker you're using or even what platform you're using. A lot of these brokers like Webull and Robinhood, they have scanners like this. They're searching the market for leading percentage gainers, and they're gonna actually send out emails and sometimes even text alerts when you have a stock that's making a big move. Why do they do that? They do that because they make money when you start trading. If you're sitting on the sidelines not trading, you don't make money. So I actually funded accounts with about a dozen different brokers earlier this year as part of a series of videos I was doing on platform demos. And you know what's funny is a lot of those brokers, I funded the account, I traded for like a week and then, did the review and was done. And now I keep getting emails from them. They're saying, hey, you haven't been trading. Hey, check out this stock. They want me to trade because that's how they make money. So I usually think of a stock that's one of the leading percentage gainers as almost being like the first result on a Google search. It's the most obvious thing that everyone's looking at. It's just kind of naturally what your eye gravitates towards. So when a stock suddenly squeezes up, as we had right here, 50%, 75%, 100%, this went from $4.50 up to $10. All of a sudden, boom, it's now on a lot of people's radar. So a lot of people are going to be watching this. It starts to dip down a little bit here, and what are we looking for? Typically, what I look for here is a light volume pullback, and then the first candle to make a new high, which ends up occurring right down here. First candle makes a new high, and then we get this rally back up. So this is a traditional bull flag. Now, it's not a perfect one. Pulled back for 3 candles. I'd usually prefer it pulls back just for 2. But in the moment when we're trading, this is what we're trying to visualize. What's going to happen next? The traders who make the most money ultimately are the traders who, to a certain extent, are able to predict the future, even if it's only for a few minutes into the future. And so what I look for in this pattern is the first candle to make a new high. And I want to talk about this for a moment because this is all about recognizing when trend changes. So right here, we have 2 candles that go up, and then suddenly the trend changes and we go down. And then suddenly the trend changes and we go back up. So what candlesticks can we look for to help us identify changes in trend? Now, in my 112-page PDF, you're going to see a number of these candlesticks already printed out, so you can check that out by all means. But what I'm going to do here is I'm going to actually demonstrate for you some of these important reversal candlesticks that we need to be on the lookout for. Because these reversal candlesticks become exit indicators. Okay, so let's say, boom, we have all of a sudden 8 a.m. breaking news and the price pops up. We get a couple candles up. And now let me actually play this to you a couple different ways. Let's imagine it looks like this. You've got a small body candle. Next candle's a little bigger. Next candle's a little bit bigger. What are these candlestick shapes telling you? The shapes getting bigger and bigger and bigger is telling us that there's increased attention in this security or in this instrument, whatever it happens to be. So what we also want to see that coupled with is increasing volume. The volume bars tell us the number of shares at traded hands. So we see increasingly large candles, increasing volume bars. That communicates really strong sentiment. So let's pull this back just one candle for a second here, just to give us more room. So let's say we got this nice rally, and then all of a sudden up here, we have this candlestick shape. What is that candlestick shape called? This is called a doji. It's a doji candle, and it's called a candle of indecision. Because what happens is the price opens and closes more or less at the same level, but during that period of time, it popped up, it dropped down, and then it came back to flat. So there's a little bit of a tug of war. Now, a tug of war, when something is going sideways, doesn't mean anything because the price is already going sideways. But a tug of war, after just seeing a couple of really big candles, this tells us the trend is becoming exhausted. So this right here is a warning sign. It's a signal that there's a bit of a battle going on right here. And in this context, there's a very high likelihood that the next candle opens, goes red, and we have confirmation of a reversal. So if I was in this position right here, if I was holding this, where would I sell? I would hold, And then once this candle closed as a doji, I have two choices. I could either sell half my position the second that candle closes, right there, or I could wait for confirmation of a reversal. The confirmation will be when the next candle right here makes a new low versus the low of this candle. So that is where I would sell the rest of my position, or if you were being a little more aggressive and you didn't sell half, that's where you would take your entire position off the table. Because what's happened here is now we have the warning sign, and then we have the confirmation of a change in trend. Okay, so now we pull back for a couple candles. And then what about down here? Let's say all of a sudden we have another one of these candles right there. Now actually it'd be a little bit lower because the candle opens and closes around the low of the previous candle. So what does this tell us? Well, once again, we had a period of selling off. So right here we're selling off, the price is declining. We've got, let's see, we actually have a couple light volume candles. So we've got volume selling off right here, 1, 2, 3, 4. And then all of a sudden down here, we once again have a little moment of indecisiveness. Now in this context, this right here represents a potential reversal indicator. So we're looking for these reversals. We call these pivots. So we get the pivot to the upside right up here. That's the up pivot coming back down. And then this is the lower pivot right down here. So now what do we look for confirmation? The first candle making a new high. So if I was short on this position right here, I'm holding, and as soon as this candle closes as this potential reversal signal, a reversal candle, I could cover half my position. My cover for the full position is when that first candle makes a new high, which was right here when that green candle broke the high of that doji. And that would be my confirmation to get out. Now on the flip side, if you have a long bias, this right here would be your place to be a buyer. You'd be buying the first candle to make a new high, and you'd be looking for a rally back through the high of day. And we would go up until what happens? We get another pivot candle or another reversal candle. That's our potential pivot, and then that right there is our confirmation. So let's create a little bit of a legend here on the back of reversal candles. So we have the first candle, which is the doji right there. That's a clear reversal signal. Now it's not confirmation, but it's a potential reversal candle. And then confirmation is when the next candle makes the new low. That's confirming the reversal, or the next candle makes the new high. A doji can be either red or green. Sometimes they're even black if the price opens exactly at the same price. So a doji candle is certainly a candle of indecision. And in the context of the price having just moved up very quickly, that would be an exit indicator. But let me show you another one. So how about the price opens right here and it squeezes up, creating that topping tail, but it closes at exactly the same price. What's that candle called? That's called a gravestone doji. It's still a type of doji because the opening and close are at the same exact price, but it's called a gravestone doji. A gravestone doji is always going to be, for me, an exit indicator. It's a reversal candle, but it's actually even worse because the price came up, came back down, we closed right at the bottom, and most likely the next candle is going to open and then drop right back down. So because it closed right at the bottom, the first candle to make a new low, basically the second this candle opens, if it drops even a penny, you have confirmation of a reversal. So on this candle right here, I sell the whole thing, and I do it before the candle closes, which means I need to be paying really close attention to what? The clock, the time. So let's jump on our chart here for a second. So as these candles are forming, we're going to go all the way forward here. So this candle right here, this is a 5-minute candle. So how much time is currently left on this 5-minute candle? About 2.5 minutes. So that means this candle still has 2.5 minutes of price action. The price could drop, it could surge back up, and the shape of this candle could change pretty dramatically in the next 2.5 minutes. Now let's look at the 1-minute chart. On the 1-minute chart, how much time do we have left on this 1-minute candle? We've got approximately 30 seconds left, right? There's 30 seconds left on this 1-minute candle, so its shape is, well, it still has some room to change, but the countdown timer is kind of approaching, right? So now we've got 15 seconds left. Now, if I saw that this candle was looking like a topping tail or a gravestone doji, as I'm watching the time, 5, 4, 3, 2, One, I don't need to wait for that candle to close. I can already tell pretty closely what that candle is going to look like. Now that candle has closed and it becomes part of history. It will never change. So candlestick charts are a historical record of all of the price action. And so when we get a reversal candle like this, I know that this is the cue for me to get out of the way, for me to exit the position. So we've got our gravestone doji, that's a reversal candle. Now, what about down here on this lower pivot? So on this lower pivot here, we're gonna erase that, we'll fix that, and we'll fix this. What if instead of a doji, we had a candle like this? What does that candle tell us? This is called a dragonfly doji. It's a dragonfly doji. Dragonflies fly up into the air, and it's still a doji because the price opened and closed at the same level, but it dropped down and rallied back up. So the act of rallying back up is seen as a sign of strength. So this is also a reversal candle. Now again, just for context, if you had a chart where you had, and this again, it could be red or green, but if you had these 3 candles in a row, they don't really mean anything because they're already showing it's indecisive, you're just going sideways. So 100 doji candles in a row doesn't mean anything. Doji candles only mean something when they occur after a series of long body green candles or long body red candles, because we're looking for what? The pivot, the change in direction. That's what we want to get focused in on. Because as traders, we want to hold as long as we can until we get that pivot. And then when we're looking for an entry, we want to buy as close as we can right after that pivot takes place. You know, we don't want to get in too soon right here and buy while it's still selling off, but we don't want to get in too late. So ultimately, this is the area where we're trying to get really focused. So let me show you a couple other candles that are reversal indicators. So that was our gravestone doji on the top. And what about this candle? We open, we have our topping tail, and then we close like this. That is called a shooting star. A shooting star is already coming back down to earth. So the candle already closed red. The next candle is going to continue red most likely, and I would have already sold the full position before this candle closed because I'm watching the countdown timer. Now, the thing with a countdown timer is that in the very beginning of a candle, there's still the opportunity that it could change shape. So it's really towards the end of the countdown of that candle that I start taking this seriously, like it's gonna be this gravestone doji, it's gonna be a shooting star. So that's when I'm really paying attention. But sometimes even halfway through the candle, or maybe even earlier, that topping tail is so pronounced that it's very clear that this will be a reversal candle. So what I notice about these topping tails are always bearish when they occur in the context of a big move up. Because what's happening is while the price squeezes up, the sellers are pulling it back down. And a bottoming tail is always bullish when it occurs at the bottom of a sell-off, because while the sellers are pushing it down, buyers are stronger and rally it back up. So this is a shooting star candle right here. So now we've got our shooting star. And now I'm going to give you the inverse on the other side, which is called a hammer. This is another reversal indicator. All right, so that's our hammer right there. It's called a hammer because it's said to be hammering out the base. And if we had this candle forming right here, I may buy even before this candle closes, because what I know is that if it closes at the top, the next candle opens, and as long as it's still carrying that momentum, immediately we're gonna have confirmation of a reversal and a pivot off the low right here. So I'm gonna go ahead and jump in when I see a hammer in this context. So now we're starting to build out a series of things that I want you to be looking for when you're in a trade. So if you bought at the beginning of this move, now let's just say for the sake of argument that the news came out, it popped up just for a second, and then it dipped down just for a moment, and you bought there on what we would call a micro pullback. So you bought this micro pullback right there. So now you're in the position and you're holding, and you're trying to say to yourself, I want to hold as long as possible. Where do I sell? So on the chart, we're going to be looking at not selling until we get a clear reversal candle, or we get candle under candle. So candle under candle is when you have candles that are making new highs like this. So they're going candle over candle. They're making progressively higher highs. The first candle that goes candle under candle is the final exit indicator. This is your confirmed exit indicator, candle under candle. And if you're trading on the 1 minute time frame, then naturally you're using the 1 minute candle under candle. If you're trading on a 5 minute time frame, you're using a 5 minute. If you're doing a 15 minute, you're doing a 15 minute. So this is all relative to the time frame you're choosing to trade on. If you're doing a daily chart, it's a daily setup. Now, as a day trader, I'm using 1 minute and 5 minute charts. And so that's what I'm looking at when I'm looking for these potential reversal indicators and then the confirmation, which is the candle under candle. It's possible that you'll have really no reversal indicator on the candle form. You'll just have strong green candles, and then suddenly this candle opens and sells off. And so then your exit for the whole position, 1 out of 100%, is the second that candle makes the new low versus the prior candle. That's your exit indicator, and that's when you're jumping out of the trade. So the first thing that we're going to be looking for are candlesticks that indicate a potential reversal or a confirmed reversal. So now let's just erase this here, and I'm going to start listing our exit indicators. So exit indicator. All right, so number one is candles. Candle shape and the confirmation. So that's the first thing that we're going to be looking for, the candlestick shape or confirmation. But that's not the only potential exit indicator that we can be looking for. The next one, we're going to look at our indicators. Now, these are our technical indicators that we have right on our candlestick charts. So what do these technical indicators do for us in terms of giving us potential confirmation that we should be holding or that we should be exiting? So I'm going to get you kind of up to speed here with what we've got on the chart. So on this chart right here, I don't have a lot of technical indicators. I'm a big advocate of keeping it simple. A lot of traders overcomplicate their charts. They put on dozens and dozens of indicators. And to be honest, you know why they're doing it? It's because they're afraid of losing. They put these indicators on because they're hoping that they will be right 100% of the time. I once had a student who was a pharmacist. I've had a few students who are pharmacists actually. But one of them told me, Ross, this is really hard for me to adjust to trading because as a pharmacist, I was in a line of work where you can never make a mistake. You can't make mistakes when it comes to giving people their medication. And yet with trading, you could be wrong 30% of the time, and that's still considered doing really well. So he had that perfectionist mentality of it's not okay to make mistakes. And it's important to differentiate that losing on a trade is not the same as making a mistake. Some trades will simply go the wrong way, you take the loss, and that's perfectly okay. So technical indicators, for me, are not used to blindly trade off of. Some people hope for that. They look for that. They want that simplicity that anytime this indicator is positive, I'm buying. The second it goes negative, I'm selling. Essentially a red light or a green light, and you're not going to get that from an indicator. The closest you can get to that is by using candlestick charts, looking for the patterns, using a combination of technical indicators, and then using your intuition. And it takes time to create that sense of educated intuition. It requires accumulating a decent amount of experience. So here's what I do when it comes to technical indicators. I keep it relatively simple. So what you see on my chart right now is as complicated as it gets. I have one trend line on there, the blue line, so I'll take that off. So the first set of indicators that I use, and I'll just flip the chart over here, or flip my whiteboard over. The first one is moving averages. Oops, that pen's too small. So we'll do this. MAs, moving averages. And I personally use exponential moving averages. So an exponential moving average is a moving average that moves exponentially faster as the price moves up because it weights the more recent price action heavily versus the older price action. A simple moving average just uses the average price over a period of time. So the moving averages I use are the 9 EMA, the 20 EMA, and the 200 EMA. Now the 200 I have in magenta, the 20 I have in blue, and the 9 I have in gray. So these are my three exponential moving averages that I plot on my chart. So you can see them right here. This is the 9. Oops. This one right here is the 9. So if I double click on that, I could change the style to make it more bold. I could change the colors I'd like. Then below that is the 20, and below that's the 200. So the way these moving averages are calculated is they're taking the price over the last 20 candles, in the case of the 20, and then giving you the average. So it's the average price over the last 20 candles. And again, with an exponential moving average, the calculation is a little more complicated because it's weighting the more recent price action a bit more heavily. But I like that because it means when the price moves, the moving average reacts quickly. So the 9, the 20, and the 200, why do I use them? I use them because they're the most commonly used moving averages that other traders use as well. And these moving averages typically create levels of psychological support. So when the price comes down to the 9 EMA, we expect it'll have support. When it comes back down to the 20, we expect it'll have support. So being below the 20, then back above, these are significant areas that you should be paying attention to for support and resistance. Then we ride that 20 coming back up, and then we're holding at the 9, holding at the 9, and then we dip back down. Now the 200 moving average usually is not something that we pay as much attention to on intraday charts, and instead we look at it on our daily charts. But on our intraday charts, usually the price action is so far above the 200 that it's not really relevant. So you can see here, the price finally comes down to the 200 and then breaks. And it breaks with volume. And that tells us that a lot of traders are watching this level. It broke, and that volume spike at the time of the break, that's a confirmation that this is a valid level that people are paying attention to. So we've got our 3 moving averages here, the 9, the 20, and the 200. And then we have this orange line right here, which is called the volume weighted average price. So VWAP, and we'll just do number 2, VWAP. So the volume weighted average price is like a moving average, except it's the average price factoring in the amount of volume that traded at each of these prices. It's an intraday indicator only. There's no complex settings for it. It's just the average price of the stock over the course of the day factoring in volume. And so we consider the VWAP to be essentially the equilibrium point. It's the average price of the stock over the course of the day. So as the stock continues trading and more volume comes in, the average will move higher or lower depending on what direction the price is going. When the price is above the VWAP, it's considered to be bullish. And when it's below, it's considered to be bearish. And sometimes when we're right around it, it's a bit of a tug of war between the buyers and the sellers to see who can regain or maintain control. And so in this area here, we also break the volume weighted average price, which is another very significant level. And so here for the first time today, this has gone into the hands of the bears. It was bullish for several hours, but now has become bearish. So that's our volume weighted average price. The next indicator that you see are volume bars. Now volume bars are really interesting. If essentially what the volume bars are doing is they're telling us the number of shares that traded hands during each candle. But if I go in here to our settings on the volume bars, just for a moment, I'm going to take the color away. I'm going to change these all to this gray color. And I want to do this and then show you, zoomed in like this, and ask you if you can guess what's happening with the price of this stock just by looking at the volume. And my guess is that you probably can't. I mean, of course, you already saw the chart, but you probably wouldn't be able to guess if I just gave this to you. You would know that something was happening here, and something was happening here, and something was happening here, but is it going up or going down? You don't know, right? You can't tell. But then all of a sudden we change this back to this color, and now this paints a very different picture because you can see all the high volume bars are green. So that tells you what's happening, buying. So now we know that the price went up, and then it pulled back, and then it went up, and then it pulled back, and then it went up, and then it pulled back, and then it came up, and then it pulled back, and then it came up again, maybe even higher, and then it pulled back, and then it came up, and then pulled back, came up, and pulled back. So volume is very important. It tells the story behind the candles. It helps communicate how much momentum is behind these moves. Is there a lot of buying or just a little bit? And so I could not trade without volume bars. They're very important. So number 3, volume bars. All right, now number 4, what's the next indicator you see on these charts? Let's get another color. Number 4 is MACD. MACD is an acronym. It stands for Moving Average Convergence Divergence Indicator. And what it's doing is it's measuring the relationship of 2 moving averages. It's telling you, are these moving averages moving apart and diverging, or are they moving together and converging? Why is that important? Well, when the price is moving quickly, your moving averages will separate. So see how these moving averages are moving apart here? They're separating, they're diverging. And then here they're starting to converge. They're coming back together. And so this panel down here is showing us the MACD. It's a representation of these moving averages as they're moving apart and then coming back together. What we know is that MACD crossovers are very significant. So when the MACD goes negative here, and you can see on the histogram it goes into the red, what I've learned is that I should not trade when the MACD is negative. So if I was still holding for some reason and the MACD went negative, that for me is a very clear exit indicator. If I am still holding and the price breaks below the 20 EMA, that is a very clear exit indicator. If I'm still holding and the price breaks below VWAP, that is a very clear exit indicator. There's almost no scenario where I should still be holding when one of those things happen. So back here, number 2 for exit indicators. So I'm going to say right here, MACD should be positive, and the price should be above VWAP, and preferably price above the 20 EMA. Now, there are certain instances where we may be okay with doing a dip trade off support when the price is below these areas. But generally speaking, if you're trading something in this area here, first of all, the price is more or less going sideways. Second of all, MACD is negative. We're below the volume weighted average price. This is not a good place to be establishing an entry. So, you know what I think we should do? To better understand exit indicators, I think we have to talk a little bit more about entry indicators. Because if you know what you're looking for to buy, and you know what you want to see right after you buy, then if you don't see those things, that by itself should be an exit indicator, right? Okay, so let's jump back onto the screen share. I'm going to give you a couple little quizzes here to see how this feels. So we've got a nice rally here up, and what you can see on this chart is that the price obviously moved up earlier and then it kind of pulled back. We were below the orange volume weighted average price. And then suddenly we sort of started to pull away and break through. Now, the problem with trading in this area here is that, to be honest, there's not a clear entry signal. This just broke over volume weighted average price. It pushed higher. Then you have 1 doji, 2 dojis, 3 dojis in a row. Those are candles of indecision. So there's a tug of war occurring up here. Most likely, they're short sellers who are trying to sell and push this back below VWAP. And there's not enough buyers who feel confident buying up here, knowing that the last red candle was way back there. So it feels like it's extended off support. And yet it pulls back here and finally starts to pull away. So in this area, short sellers are likely covering, and maybe some long bias traders are jumping in just to ride the momentum, even though the entry wasn't very clear. So now you get a proper pullback. So if you were holding during this wave right here, where would you have sold your final position? The candle under candle. Exit indicator number 1, candlestick shape. Now, we got the confirmation. We had a couple of indicators here in the form of the dojis, which you could have chosen to sell the whole thing on if you were in, or you could have sold half and then said, I'm going to hold and wait for that candle under candle confirmation to sell the rest. Now, the only reason you'd be in here is, I suppose, if you bought back here or for the break of VWAP, which is a bit of a more advanced strategy. So I don't know if that you would have done that. But in any case, let's just say you were in. Where do you finally sell? Right there, first candle to make a new low. So now the price is pulled back. Would we consider taking an entry around this area? Well, what we can say is that right in this candle, we have a bottoming tail. Our MACD is currently positive. We had high volume buying. We have light volume selling. And so potentially the first candle to go up to make a new high, candle over candle coming back up, could be a buy signal. And in fact, that's exactly what happened. Your first candle to make a new high right there is the buy signal. Your max loss is the low of the pullback. And as soon as that candle over candle formation occurs, you're in the trade, and now you're holding until you get a valid exit indicator. Now, in this instance, the stock ended up halting up right here. It resumed, it dipped down for a second, and then it surged higher. Sadly, the active dipping down there would have caused me to sell. And even though it's disappointing because it went higher, it would have still been the right decision to exit when that first candle made a new low, because it could have gone lower and it was still a winning trade from here to right up here. So that's a winner. Now it ends up rallying and pushing higher, dipping down, pushing higher, a couple of topping tails, And then this certainly would have been a reversal indicator right there, that first candle to go red, candle under candle. But the topping tails would have been early signals that possibly this trend is getting exhausted. So from the perspective of candlestick charts, at this point, we have exit indicators, topping tails, candle under candle, and then at this point, the MACD goes negative. And so from that point further, there is no trade to the long side, and there is no way that I should still be holding. We break below the 9, we come down to the 20, we're still above the VWAP, but MACD is negative. So your first exit indicator on this really was in the form of the candlestick shape. And that's something that's important to recognize. All of these indicators require candles to close so they can take the data to create the calculation for the indicator. So indicators, therefore, are lagging behind price action. So if you really want to get the fastest exit indicator, you're going to get it most likely from the candlestick chart itself. Here's another example. So we've got a nice rally up. We've got a sideways consolidation. So I could ask you first, is this a place you should be a buyer right down here? The answer for me is yes. Our MACD is positive. We've got a pretty good volume profile, slightly higher red volume on those two candles, but it's a nice consolidation right at the support of what? The volume weighted average price and our 9 moving average. So that's an entry right there, adding for the break through the high of day, and this ends up squeezing all the way up through here. Where's your first exit indicator? The topping tail here, when this candle closed, even though this candle didn't make a new low, that larger topping tail is an indicator of the trend being exhausted. So this would have been a place as that popped up and then as that came back down before the candle closed to take at least half off the table. This candle, green, doji, bottoming tail, okay. Next candle's red, and I would exit there. The following candle makes the confirmed candle under candle, but since this candle was closing red, it was likely the next candle would open and just continue the sell-off. So you sell right there before the candle actually closes red. Now we have a pullback. So, all right, we've got a pullback. Do we consider getting back in? So we wouldn't if this just continues to go red. What is our entry indicator? What's that entry signal? It's going to be the first candle to what? Make a new high. MACD is positive. We've got a good volume profile, so this could give us that setup, and in fact, it does. First candle makes a new high. Now, where do we sell? In this case, this squeezes all the way up here. The next candle's red, and so as that candle is confirmed to be closing red, I would exit the position. The next candle confirms by making a new low. There's no reason to wait for that candle to close red. If it's clearly going to be red and you only have a few seconds left, you might as well just sell the position. So when it comes to entry indicators, we'll make these in green. This is positive. So entry indicator. Indicator. So obviously we want to have our candlestick pattern. Candlestick pattern should be valid. And then we want to have the candle over candle formation, which is basically we have that pop up. It's the first candle to make a new high. The dip down, and then right there is the first candle to make a new high. Okay, so we want to see that. We want to make sure indicators support the trade. In other words, that they're not negative. We're not below the VWAP, we're not below moving averages, and our MACD is positive. We don't have an issue with volume profile. Number 4, as soon as I get in, so these are entry indicators. So as long as I have these checking out, and of course, number 4, we've got an obvious stock. That should really be number 1, but I'll just put it down there. So we've got an obvious stock, meets all 5 pillars of stock selection. We got the pattern, we've got the candle over candle, we've got the indicators that support the entry. We're going to take the trade. So as soon as we take the trade, what do we want to see? What does confirmation look like? So now we're going to say confirmation. Confirmation is what? Price going up. So in order for the price to go up, we cannot have no big sellers on the level 2. At the end of this episode, I'll put a link of how to read level 2 for those of you guys that don't already know, so you can learn more about it. But we should have no big sellers on the level 2. The price should be going up. Number 3, green on the time and sales. So that confirms we're seeing the orders flowing through the depth of market, level 2. So we're seeing all of those buy orders going through, and all of a sudden, boom, the price is surging up. That's what we want to see. That is confirmation of our entry indicator. We had our entry indicator, we take the position, and then the price moves up. We've got no big sellers on the level 2. We've got green on the time and sales. So if this is confirmation of a good entry, then can we take these to help us understand potential additional exit indicators? So what I would say is that if suddenly we're in the trade, and let's just take this off, so we just make this number 3, the price starts going down, that's obviously a problem. If we have number 4, big sellers on the level 2, that's a problem. And if we have red on the time and sales, that's a problem. So all of a sudden, not only the lack of these is a problem, but the active inverse is a major issue. So now we have big sellers on level 2, we've got red on the tape, we've got the price going down. These are exit indicators. And so the interesting thing with level 2 right here and your time and sales and the price going down is that the candlestick, so if the technical indicators get their information from candlestick shapes, where do candlestick shapes get their information from? They get their information from the actual orders that go through the market. So now you want to get one step ahead and really straight to the source. You got to look at the depth of market. You've got to look at the level 2 and the time and sales, because that's where you're going to see that burst of green right after you got in. That's the confirmation that other traders were seeing the exact same thing. Or you get in and suddenly you see a 100,000 share seller on the ask. That's a big sell order. We're probably not going to be able to break it. Now, when we look at Zcar from this morning, this is a stock that basically surged straight up. So the way I bought this for my entry indicator was actually using that 10-second chart, because this showed me that micro pullback just after it started to pull away. So we had a really nice micro pullback. Well, you could see one right there. So it surges up, it dips down for a moment, and that's that opportunity to jump in with a stop right down here. Now, as soon as I'm in, I switch off the 10-second chart, which I just used for that early entry, and now I'm looking at the 1-minute chart and waiting to see if I get an exit indicator. So as long as the price is squeezing up, as long as we're not seeing big sellers on the level 2, as long as we're seeing green on the time and sales, my indicators, those are all fine. This is at the beginning of the front side of the move. It's squeezing up, and I don't see any bad candlestick shapes. I'm holding. So where's my first exit? I can take some profit off at this red doji, knowing that that's a candle that is a potential reversal indicator. So I could take some profit off. We get that final push a little bit higher, then a topping tail right there, and then finally the candle under candle formation right there. And then before you know it, the MACD is crossing into the negative. And right there, this is a stock that went up 100% in basically 4 minutes. Now, this is being a very easy stock for someone to buy down here at 5 and sell at 5.50 and then watch it run $4 a share without them. And this is the thing that you don't want to do. You do that and you're capping your upside potential. You want to get in a trade like that and hold it as long as possible. Now, there's nothing wrong with paying yourself and taking a little profit off the table. I'm a big advocate of that. But at the same time, if you had such a good entry and it goes that far and you realize you sold way too soon, there's got to be a party that's asking, what can I do to hold a little longer? And so the thing I'm going to tell you is look and wait for those true exit indicators before you sell. Now, if you want to get better at reading the level 2, I'm going to put a link to another episode right here. I'll put links to other full trainings right here. And I want to remind you, as always, that trading is risky. My results aren't typical, so please manage your risk and practice in a simulator before putting real money on the line. Thanks as always for tuning in. I'll see you for the next upload real soon.